Okay, have you ever looked at your business's bank account and just felt confused? You think you know how much money should be in there, but the number the bank is showing tells a totally different story. Well, you're definitely not alone. Today, we're going to solve one of the most common financial puzzles out there, bank reconciliation.
Right? This is the big mystery. It's that classic problem that every single business owner, accountant, and even accounting student runs into. One set of books says one thing, your bank statement says something else entirely. It feels like someone, somewhere, has to be wrong. So picture this. Your own records, your cash book, are confidently showing a balance of $10,000. But then you log into your online banking, and what's staring back at you? $8,000. That's a $2,000 gap. Where did it go? Is it a mistake? Did you mess up? Did the bank?
But here's the secret. Most of the time, neither of you is actually wrong. This difference, well, it's pretty normal, and it's a mystery that has clues we can follow. So think of yourself as a financial detective. That gap between the two balances, that's your first lead.
All right, detective, let's get into the investigation. Like any good mystery, there are always a few usual suspects that we need to look at first. These are the main culprits behind why your cash book and your bank statement just don't seem to want to line up.
And here they are, our top 3 suspects. Our investigation is going to focus on these guys. First, timing differences. And trust me, this is the most common one. Then, unique transactions. These are things that one side knows about before the other. And finally, outright errors. They're less common, but you for sure have to check for them.
Let's start with our prime suspect, the one that's responsible for, I'd say, most of these cases. Timing. It's really all about the natural lag, the delay between when you record something happening and when the bank finally gets around to it.
Think about the simple journey of a check. On day 1, you write it out to a supplier. Instantly, in your records, you deduct that money. To you, it's gone. But for the bank, it's like it never happened for 4 whole days. Only on day 5, when that supplier finally cashes it, does the bank's balance drop. That gap, right there, is a perfect timing difference. Okay, on to our second suspect. This one's all about a little bit of, inside information. We're talking about transactions that the bank itself kicks off, so they pop up on your statement before you even have a chance to write them down in your own books.
And these are all totally normal things. The bank might hit you with a monthly service fee. Or maybe, on the bright side, credit your account with a little bit of interest. Or maybe a customer paid you directly with a wire transfer. The bank knows about all this stuff the second it happens. But you usually only find out when you get that statement. So, we've got all these suspects, we've got our clues. How do we actually solve the case and make those numbers match up? Well, we use a special tool, one designed for this exact job. The Bank Reconciliation Statement, or BRS for short.
So that's the official definition. But what it really means is that the BRS isn't just about getting to a correct number. No, it's about systematically laying out every single reason for the difference, every timing gap, every bank charge, to prove that both of those starting numbers were actually correct, just from different points of view. It's basically our completed case file. Now let's get practical. How do we actually build this thing? Solving this mystery really isn't that complicated, as long as you follow a clear set of steps. We can break the whole thing down into a simple 4-step investigation.
Here's your roadmap. It's pretty straightforward. You start with the number you trust, your cash book balance. Then you start adjusting for all those differences we just talked about. You'll add the good stuff the bank knows about that you don't yet, like interest. Then you'll subtract the stuff you know about that the bank doesn't, like that check we wrote on day 1. And if you do it all right, you'll land perfectly on the bank statement's balance.
Let's see this in action with some real numbers. We start with our cash book balance, $240,000. First, we add back the checks we wrote that haven't been cashed. That money is technically still sitting in the bank, right? Then we add the interest the bank gave us. Next, we subtract the deposits we made that haven't cleared yet, and we take out those pesky bank charges. And voila! Just like that, we land perfectly on the bank's number, $286,950. See? Case closed. Okay, so we solved the puzzle, the numbers match, we're done, right? But what's the real payoff here? Why should we go through all this trouble every single month? Well, it turns out this isn't just some boring accounting chore. It's actually a super important tool for your financial health and security. Now, I know this sounds a little dramatic, but it's a really important point from our source material. Just knowing that the books are going to be meticulously checked against the bank's official records, that creates a huge deterrent against fraud.
It's an absolutely essential internal control.
So the real value here is massive. It helps you catch errors, either yours or the bank's. It helps you spot problems, like checks taking way too long to clear. And maybe most importantly, it gives you a crystal clear picture of your actual cash position, which is, kind of vital for making smart business decisions. It's all about clarity, control, and security. And that's really the final thought I want to leave you with. The bank statement, it shows one number. Your cash book shows another. But the reconciliation process, that's what reveals the truth behind both of them. It's the only way to know for sure what your real financial standing is. So the question is, are you ready to solve the case?